following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for unusual options activity alerts, advanced trading strategies, cutting-edge education, detailed market updates, and breaking customer activity. It's time for the One Option Show to rule them all. It's time for the Option Block with your hosts, Mark Longo from theoptionsinsider.com, Mark Sebastian from OptionPit.com, Mike Tusaw from KnowYourOptionsInc.com, and John Griegas from Options Express.
Welcome back to the Option Block. I hope you enjoyed that little segue we took into live recording land last week, where we had a chance to get together most of the panelists and do a nice little quick live show down from the Futures Industry Expo in Chicago. Mike, I'm not sure if you had a chance after we recorded to kind of walk around the show a bit, but we love going down to shows like that because the entire industry is in town for a few days, you know, so you can talk to just about anybody you want to talk to. So that makes it kind of interesting for us. We get the chance to sit down and chat with a pretty broad cross section, everybody from brokers to exchanges to trading firms to vendors to, you know, you name it. The guy who sells some weird little front end for doing, you know, ratio spreads to the guys who run the CME or whatever it might be. You know, it's just a great chance to check out the derivatives world. Did you have a chance to meander around it all?
I did get a little bit of a chance to. It was good to see some people I hadn't seen in a while, so I haven't been I've been doing a lot of stuff from behind the computer screen in internet land, and so to actually see people face to face again for the first time in a while was really nice.
Yeah, there's that networking aspect to it too, which is also nice. And it's a ridiculous vendor show. It's like, I don't know, like hundreds of vendors down there. It's insane.
Mm-hmm. Well, I got an interesting story for you on that. I was there a couple years ago, and I remember, you know, it's for those of you that have never been to an FIA show before. Usually, towards the end of the day, they start giving out alcohol. The attendance to the show next year is going to double just by that comment alone. But it's common that a lot of places start giving out alcohol later in the day. And I remember I was there when I was working for Options Express, working the booth a couple years ago. And at the Mexican exchange, it's 9 a.m. the day after, and they just have coolers full of Coronas. I'm like, are you guys supposed to be giving that out right now? And they're like, hey, this is how we do it in Mexico. 9 a.m., party up. So I couldn't believe that.
I love it.
Something else.
That's great. And I'm remiss that I missed the Mexico booth this year. I'll have to go back next year. Yeah, I'll say, hey, it's 9 a.m. Where are the Coronas?
Exactly.
That's something.
The Trading Block.
Looking into the old trading block here, you know, not too much lighting up the tape today. The market's drifting down south a bit. S&P's down about 3, Dow down about 40 or so. VIX cash slightly up, as you might expect, to about 1837, but still well below that historical 20 level that a lot of people like to latch onto. That's kind of seen in a lot of circles as the psychological support. And you get below 20 in the VIX cash, it's starting to be seen as relatively low vol, particularly in the new frame of reference where, you know, the new moderate to average vol is anywhere from the high 20s to the low 30s. So there's a lot of people thinking that maybe this kind of gets into what we've been talking about a lot over the past few weeks, is just maybe there's been a tendency to oversell some of the vol out there, particularly when we see what's going on.
You know, is there though? I mean, take a look. I mean, yes, okay. The VIX is kind of low, but take a look at how much we've actually been losing. We've actually been moving. And you make a case you prove to me that we should be, the VIX should be trading anywhere above 20, looking at how much the market has moved over the last, you know, save the NDX, okay? looking at over how much the market has been moving every day, you show me that the VIX should be anywhere near over 20.
Broad indices were up, about 3% on average for last week alone?
Yeah.
Factoring that in with all the extended upside we've been seeing, you expect to see some sell-off.
Yeah.
On the pessimist note, or on the on the other side of the coin, you can say that the election is over. We saw a lot of that activity. The QE2 has been announced.
Mm-hmm.
So we can digest that. So a lot of the major activities, most of the big major earnings are pretty much behind us now.
Mm-hmm.
So I guess you could say we're almost heading into another period of instead of the summer doldrums, we have the holiday doldrums.
Yeah.
Mark, sounds like you're kind of coming down on the other side of the coin now. You think vol is right where it should be?
Yeah, I mean, well, I think there's a difference between a directional market and a volatile market. What we've looked at here is a lot of small days where we've gone in the same direction, okay? And with very, very few multi-standard deviations mixed in there. I mean, if you look at the very beginning of this rally, okay, which was kind of, I'll call it September 1st, okay? In fact, I'm not going to call it September 1st. I'm going to tell you it's September 1st, okay? How many really huge days did we have over that time period? And I mean over 20 points in, plus or minus on the day.
Not that many.
Two. We had the first, and then we had last Thursday. And that's it. Oh, you know what? I take that back. It was 3. We had one on the 5th of October as well. I apologize. So, when you think about it, what does 18% volatility equate to for on like a day-to-day basis? Let's say, 1 over with the SPX trading, let's say 1220, 1223 where we closed today, right? Or no, we closed
1223, yeah.
1223 and a quarter, right? 1223 and a quarter. Let's see, 1 divided by 255.
People are scratching their heads. You're using trading days, not total days of the year.
When I'm doing a single day and I'm measuring standard deviations, when I'm doing any time period under a week, under 5 days, I like to use trading days. Anytime I start bringing in a weekend, I use calendar days. When I'm doing very short bursts of time that I don't have to deal with kind of the weekend effect, I like to use trading days. I don't know, that's just me.
It seems to be almost a subjective thing at that point. I kind of lean the same way. If you're doing anything that you're factoring in your net impact, especially with time decay, I use everything.
Mm-hmm.
You're not getting any free days there, but something like vol is primarily limited to your trading days, so that's where you want to focus most of your activity there.
Right, yeah. With a VIX of, 1829, all right, if you look at how much we should actually be moving on a daily basis, okay, with the SPX trading 1223, so we're going to do 1 divided by 255. We're going to take the square root of that. I'm going to multiply that times 1223. And then I'm going to multiply that times our VIX, which closed at
1829.
Yeah, now remember, everybody, the VIX is actually a percent, okay? It's one of the things that drives me nuts when people
quoted as $1, $18 for the VIX.
Yeah, times 0.1829, and we're looking at the SPX should be moving about 14 points a day. If we go over the fact that the SPX has really only moved over 20 points 3 times in the last 2+ months, and I bet you if I went through our average daily range, it would be under $14 if I had to bet. I mean, today our total range was 7 handles. On Friday, 6.79. All right. Wednesday, 8. Tuesday, 18. Now there's a big one. And this is range, not even high-low or not even open-close. Okay. So if you look at volatility, really, I don't think implied vol is that cheap.
I tend to think of it not just as an intraday, is it fairly priced, but also, long-term, where would I position here?
Oh, yeah.
In terms of long-term, where am I looking at the VIX? And we talked before, I'm looking actually while you were doing that, I was pulling up some skew charts on the VIX and on the S&P just to see where some of the long-term farther out months are. They seem to have leveled off a little bit, but nothing crazy. So there still looks like a preponderance of belief that the near term is relatively cheap and fairly priced. But long term, I think most people would expect the VIX. If you had to pick north or south, I think you got to lean north on this one.
Yeah. Well, yeah, the futures are still in contango, although albeit far less than they were even when we had Bill on a couple of weeks ago. They've really flattened up. So, I think that I agree with you that if somebody was like, Mark, in 6 months, are we going to see 25 first, or are we going to see 12, 15 first? Okay? I'd probably give you 25. All right? But, I don't think I think it's certainly at the low end of its range. I don't know if I'd call it cheap, would basically be what I would say.
I remember quite a few times down when I was in the SPX of hearing guys saying something similar along those lines. SPX ATM vols at 15. This is ridiculously cheap. You have to load up here. And, of course, it'd be maybe the beginning of summer or something like that, and the vol would continue to drift down even lower, and those guys would blow out. And so you definitely, whenever you make those kind of pronouncements, you always have to have the caveat or the asterisk there that obviously these things can trend lower. But I'm speaking in generalities in terms of my own long-term view. I've kind of viewed the market as being a bit overbought, and the VIX is perhaps a bit oversold for some time now. So I would lean heavier towards those two things correcting.
Yeah, I would agree. I think we're a little frothy here. I think we're a little frothy. So
think back to fall of '08 when the VIX was around the 40 mark, and everyone and their uncle was just convinced that it was just so high, and how can the VIX possibly go any higher? And we all know what happened a couple of weeks later.
Yeah.
Yeah. I haven't kept up on it recently. Maybe I'll pull this up for the next episode or so. But I'd be curious to see how the options activity is holding up out there in VIX now that we're at these levels.
Yeah.
A lot of our listeners are in that intermediate to high end retail category, and I'd imagine a lot of them have curtailed some of their VIX writing.
We're seeing it. A lot of the volume. The volume is really interesting because there are a lot of people that use this as a legitimate hedging product. And so you will see massive call buying on like the 35s, on the 40s, on the 45s in time periods like this because it's cheaper to buy these VIX upside calls than it is to actually buy downside skew a lot of times.
Yeah.
So, that volume has absolutely persisted.
So that gets into a lot of what we talk about, too, with people coming in who are always complaining about, especially covered call writers, that they can't get any good premium anymore for their upside calls, so that upside skew has just been hammered to death. The flip side is that if they start writing in the money calls, they can start benefiting from some of that deep downside skew, which is usually a little richer. And vice versa for the VIX. If you go to the upside, you can get a little more bang for your buck.
Oh, yeah. For your covered call writer would many times probably be better off selling put spreads than doing covered calls, But a lot of people see that as some sort of crazy risk, and it's not, I'm sure you've kind of seen that, Mike, at Know Your Options, right?
Well, yeah, it's one to where a lot of people just don't. It's all about the perception of risk, and in reality, if you over yourself and do a bull put credit spread with a 10 lot when you were normally considering doing a 1 lot covered call, then the perception is that it's way more risky, and rightfully so, that is. But if you're doing a 1 lot bull put spread and keep the remainder of money in a money market, then a lot of people don't view it that way, and then it's unfortunate, but that I think is a very valid approach.
That gets into the whole perception of covered calls as completely risk-free or risk-neutral, and naked short puts as the most risky thing ever. That's a conversation. That's a long conversation for another day. But yeah, we see quite a bit of that. Which is why I think a lot of the savvier covered call traders have migrated towards either the put spreads or the in the money calls, just to take advantage of that meatier section of the skew curve. One last thing we wanted to. Just as the rundown, we always mention, some of the broad indices. I thought I'd throw in some of the commodities, too, just to mix it up a little bit. I know You're Mr. T over there. You love the commodities. So you trade the ETFs. Mostly you trade the futures because we got GLD here up about $1.32 to 137.70. You trade GLD a lot, Mike, or do you go for the futures?
Yeah, we have a lot of clients that have long-term positions in GLD, and typically what we do for it is we collar it, and we just kind of view it as more of a long-term holding. We do a little bit of both. We don't have anyone in any gold futures right now, but we aren't against it, so to speak, should the situation arise.
Now, the other one I pulled up is just USO, which is obviously the U.S. oil ETF that closed down about 6 cents, so about unchanged to 37.60. I know a lot of people have issues with using this ETF as a proxy for the oil market. What's your opinion on USO there, Mike?
You know, if you're going to trade oil, why not just trade oil is kind of my take on it. I think USO, it's a nice thought, but with what happened with UNG, which is of the same company that has a similar concept with natural gas, they also use UGA for gasoline futures. I'm of the school of thought that if you're able to and you have the money to do so, I'd prefer to just go with the futures or the futures options. Now, obviously, if someone has a smaller account or they want to get a little bit more direct with the sizing of the specific contracts on the ETF, then I wouldn't be adamantly against it, but I'd strongly prefer the futures and the futures options over the ETF. And even if someone wanted to put like a larger non-levered size position, like let's say someone wanted to put $80,000 into USO because they wanted to have oil exposure, I'd feel more comfortable having them do a one lot on crude oil just because of the fact that you know what you're getting. You don't have to worry about position rolling. There's more transparency. Granted, the margin requirements on the future side don't require anything near that, but I'd still feel more comfortable with them having that along with the rest of the money in money market if they're able to do so. Now, obviously, everybody's different. Different people have different account sizes and different needs, but that's typically what I tend to prefer.
Yeah, it's kind of like trading Halliburton versus trading oil, direct. You're getting the pure play as opposed to the indirect play. Of course, this kind of brings up the problem we discussed a few times now on the show about the lack of good bite-sized, retail-sized choices in a lot of these futures products for the retail audience. And we talked about cotton earlier, a couple shows ago, I think, with Tim, and now oil, the same problem. Obviously, there's a demand for it because people are flocking to things that are imprecise at best, like USO, but there definitely should be more of a movement towards something that is more palatable for the retail audience. Of course, look how long it took to get GLD off the ground and options on that. So
totally.
Yeah, and the reason that I like GLD and SLV because they actually own the physical gold and the physical silver. That's why I have no problem trading those if need or for investing in those for clients as well. But when you're trying to roll futures within an ETF, it's almost like the ETF company is doing what the futures exchange could be doing themselves and collecting on and benefiting from in their own way. I think I would love to see like a micro contract on oil, for example, because if you're doing a one lot, if you're doing a one lot on mini crude, granted the margin requirement isn't all that much, but in reality, if you're long, you got $40,000 worth of oil exposure should oil go to zero, theoretically. So if we could get some type of micro contracts on oil, I would love that.
All right, and that was a interesting trading block. We kind of went literally almost around the block, which is our other segment. And so with that, we will close out the trading block and move on into the odd block.
The odd block.
And welcome to the odd block. This is the spooky segment of the show where we get some bad jokes from Mr. Sebastian, and then we go into some unusual activity that's lighting up our tape today. So we're going to start it off today with Pfizer, PFE. They closed about $17, down about 17 cents. And we saw some long-term players actually out in Pfizer today. And looks like these people were expecting Pfizer to go nowhere for at least the next 6 months or so, out to June 2011. The activity started up in the morning. We had some strangle sellers coming out and hitting 1,000 of the June 15 puts for about 72 cents. And they also sold 1,000 of the June 20 calls for about 47 cents. So that nets you $1.19. So obviously these guys are thinking that Pfizer isn't going much south of 16 or much north of 18 anywhere before June. And then we had a more sizable trade coming out with another person leaning the same way, expecting Pfizer not to really go anywhere by June. And this trader came out and hit about 4,500 of the June 17 straddles, so exact at-the-money straddles. He sold those for $2.71. So this guy is thinking, obviously, that the stock's not going to drop below about 14.30 to the downside or 19.71 to the upside before the end of June. So interesting, two different ways to play a similar outlook, which is that you don't think Pfizer is going anywhere anytime soon. Of the two, I'm not sure which one of those two I prefer. I kind of like the strangle, I think, a little bit better, though. It gives you a little bit more. Obviously, you're getting less premium for it, but you're also getting a little bit more play in there. I'm not a huge Pfizer guy, though. I don't have much of a read on this underlying. Are either you guys watched Pfizer quite a bit? Do you have any input?
I'm long some Pfizer, and yeah, I mean, I could see that. When was the stock has done nothing forever. You know, it is to drug stocks what Microsoft is to tech stocks, if you look at it. You haven't made much on the upside, but you certainly have had your chances to lose. You know, it just kind of sits here. The total range since kind of the beginning of 2009, over the last year, has been, you know, we had a little dip down where it got dangerous, but aside from kind of the flash crash dip, we've been looking at about 16 to 18, almost exclusively, save a couple of small little blocks. You know, it's just, it's kind of, it makes a lot of sense for somebody to want to sell premium this thing. I'm kind of with you. I think the strangle's the smarter play. But yeah, I would just, sell the cream and live the dream, as they say, right?
I guess the thing you got to watch out for if you're a size premium seller in some of these drug stocks is obviously you have to know your drug calendar pretty well. You have to know what's coming up at the FDA for approval, because one approval or one rejection of any drug could blow out both of these trades. And so I guess you have to really be pretty familiar with what Pfizer has going on and all the various lawsuits and things like that to be comfortable enough to sell 6 months worth of premium out there. I mean, for me, like I said, I don't follow the drug stocks that much, so I'd have to dig in a little more before I'd feel comfortable selling premium for that long of a time frame. But yeah, if you know your drug stocks and you think Pfizer's hanging around 17 for the time being, then yeah, I kind of like that strangle. What about you, Mike?
I think with drug stocks, I'm not a fan of premium selling. Typically on the drug stocks, I'm a fan of my old friend, the bull call spread, just with a smaller amount of capital, or just owning the stock and being able to ride it through the downturns, just because of the fact that as a premium seller, I wouldn't have a problem selling premium if, for example, I wanted to get into it at the level of where the short put was, or I wanted to be short it where the long put, or I'm sorry, where the short call was. But as a levered trader, I'm more of a fan of just picking a direction and doing a spread, or just being long it or short it in a non-levered standpoint, just because of the fact that if you have, like you had said, a lawsuit, a drug announcement, or something along those lines, I don't care how well you know it, that's something, well, I guess if you have insider information, maybe it's okay and you're being illegal, but I don't care how well you know it, an event like that can turn a stock on a dime in a heartbeat. And with drug stocks, that's definitely a major risk. So I'm typically a fan of playing the drug stocks a lot more cautious.
Well, then maybe we'll move on from Pfizer to a drug that might be, or to a name that might be a little more in your wheelhouse, Mike. That is Silver Wheaton Corp, SLW. They closed at about $35 today, up about $2. And usually this stock does about 20,000 contracts a day in average daily volume. Today it was about 80. So we're talking about 4 times their average daily volume, with a lot of the options people piling up onto the bull side today. The stock was up, about 4.5% today. and they hit a new 52-week high today. Their earnings are actually, I think, this afternoon, so maybe we can pull them up and see how they're doing. But, yeah, a lot of just plain vanilla call buyers coming in here. We saw people picking up 1,000 of the No 34s, so these were out of the money. Now they're in the money today because the stock was up about $2. So they picked those up for about $1.33. People also picking up another 1,000 of the No 35s. These are for about $1 a piece. And so these guys are all kind of just, you saw a lot of bulls. We also saw a little bit more of a maybe more hesitant or more cautious player coming in using what Mr. Sebastian was talking about before, the old debit put spread. And he picked up about 2,000 of the Dees 35, so playing in December as opposed to November, for $2.84, and he sold 2,000 again of the Dees 32 puts for $1.40, so he paid him about $1.44 for that spread. And so he's looking for some sizable, about 7% downside to Silver Wheaton in order for this one to play up. Not surprisingly, all this buying activity, applied vol's up about 10%. Of course, you also have earnings after the close today, so that's also contributing to the implied vol. But is this a name you watch quite a bit there, Mike, or Silver Wheaton?
Typically, no. Usually with silver and gold, we try and just stick to the commodity itself, and that we don't want to have too much of the stock exposure on it. But with this, I think it's definitely an interesting play with gold and silver doing what they're doing right now. If this is a company with which you believe in, with which it looks good technically to you, with the fundamentals looking good to you, and you believe that earnings are going to work well, then I think this could definitely be an interesting spec play from standpoint that you have a bull market in silver. And if this, like I said, I don't follow this company, I don't know this company, but if this is one to where you believe it has some pretty good people running it and it has good reason for it to increase based upon the company itself, I think it's a very interesting play.
Yeah, I guess this kind of gets back to what we were talking about before, whether do you want to play the pure underlying and just go silver, or do you want to play some of these, affiliated names? And then, so I guess if you want to play the affiliated names, this is the way to go, or apparently a lot of people certainly see that. I haven't pulled them up. Sebastian, can you see what they're doing right now in the after hours? Anything interesting on their earnings? SLW?
Yeah. What was their symbol again?
SLW.
SLW. It was up $2 today.
Yeah, that's during the day.
It's not doing anything after the bell right now. Bid a little bit higher, but I don't think they've announced yet. It's interesting. I don't know how big of an earnings stock this is. I mean, everybody knows silver companies are killing it right now. But I'm kind of with Mike here. Unless you know that you are getting the absolute best company in these commodities, like, you can make an argument, something like Petrobras in oil makes some sense because they just are great and they've got kind of a monopoly in Brazil, things like that. But unless you're getting the absolute best of the best in a particular commodity, I'm not always a big fan of getting into these types of trades either. Especially, this is a Canadian company too, so I don't know about you, but I live that kind of buy American silver, not Canadian silver. That's me.
I hate that darn Canadian silver.
That darn Canadian silver. That's all I need is I buy some silver coins from this company, and they send the Queen Mother on. They got the Queen Mother on there instead of good old George Washington. So,
like a good old some jingoism to round out the old odd block there.
Yeah, nothing like a little nationalism.
All right, and we'll close out then on the SLW, and we'll move into another one, Priceline. This is one I lit up our tape a little bit today. They have earnings coming out, and this is one of those names that I haven't really paid attention to them in a long time. These are one of the darlings of the old tech boom. Everyone loved them. Everyone remembers when William Shatner got a huge chunk of stock from these guys for being their spokesman. But I haven't really followed them much lately. After seeing them come across the tape, I kind of fired them up today a little bit. Pretty rich stock, trading $388 right now. So maybe they're trying to replicate the old tech days when Yahoo was like $450 and that kind of stuff. But pretty pricey up there for a single share of Priceline. And it looks like we're seeing people are still liking Priceline. We got some medium-term bulls lining up. We got a guy coming in today picking up about 2,000 of the Jan 390s for $31.
He's happy it's at 410 right now in aftermarket.
Is it really? Okay, so yeah, he's getting close then, yeah.
Yeah.
He did it on a bit of a ratio. He did a spread, actually. He bought 2,000 of the Jan 390s for $31. Then he sold 2,700, so you're talking like a 1 to 1.2, 1.3 or so ratio. The April 430s for $29.
Oh, I love that spread. That is one of my favorite spreads.
The 1/3 ratio upside time spread?
Oh, that is the best kind of spread. That spread is awesome if you think the market's going up. This is one of my favorite kind of trades. All right. So what he ends up doing with the stock trading about 390.
Should we clarify first? Was this you, Sebastian? Was this putting on this ratio?
I wish. All right. Because what this is something that appears relatively delta neutral. Okay. But what it is it's a massive bull spread if vol drops. Okay. So what he's done here is he's gotten long the at the monies. All right. Which were at the time probably about a 50 delta. All right. Then he just unloads. Okay. Kind of overweight some of these 430s, okay? Probably does it at, I'm guessing he did a premium neutral probably, if I had to bet. Let me see here. So he's got a big long gamma, short vega position that if Priceline does this, goes to 410, okay, and vol collapses, he is going to wake up tomorrow long a lot more deltas than the model was saying that he was when he left this afternoon. So he probably has, if you look at this trade prior to the close, okay? So let's say you did this smaller. So let's say you did this 22 by, 28, okay? When he drops the vol, so he puts this thing up at 410, then when he drops the implied volatility, okay? So let's say he drops the Jan, I don't know, what do you think, guys? 3, 4, let's take a look at implied vol here. That's pretty 33% in versus 20. Oh wow, it's hard to get a decent vol with the price right here.
Yeah, earnings are going to screw it up.
Yeah, so we'll drop Jan $10 just to be overly certain, and then we'll drop April by even 5, and you could probably do even more than that. We'll drop April by like 8, and he's up. He's long 2.5 times more deltas. All right, if Jan is down 10 and April's down 8, all right, this guy is up. I'm going to do his size now.
He did 2,000 by 2,700.
Yeah. He's up a cool $600,000 on the trade, and he's long 50,000 deltas. So, good trade. Cheers. I like it.
With that, Mark, let me ask you this: what ratio, like a retail trader, what ratio would usually work out best for that? What this guy did, or maybe a 1/2 or a 1? What's usually best?
When I see it, I either like to set it up delta neutral or premium neutral, and actually a lot of times it ends up even. So if you consider that, going into today, the 390s were about a 50 delta, and the 430s were probably something along the lines like a 40 delta.
Yeah, probably like a 35 or so, something like that.
Yeah, 35. So you might end up you might do 4x5 or 3x4, something like that. So you buy 4 of the front months and then sell 5 of the backs. And you know what? You'd be up a cool $1,000 on a trade like this. And the neat thing is this has it has a really, really nice mitigated risk on the downside if you're wrong, is what I really like about it, because you are setting up premium or delta neutral. You're really taking advantage of the fact that if the market drops or if the market rallies, you're going to be short the stuff that is rallying into, okay? If the market falls, well, you're long the stuff that's kind of closer to where it's trading, so you're going to keep a lot more of that vega. It ends up being a really, really nice trade.
Yeah, it looks like he must have done it on a delta basis because he actually collected some premium on that ratio. So he didn't do a premium neutral. Must have been leaning more towards the deltas.
Oh yeah, this is a great trade for those that have portfolio margin. For those that are pros, this is one of my favorite plays into an earnings stock because you don't need as big of a move as like a straight straddle, and you're really trading off the Vega as opposed to the gamma. So it's really, if you understand options, it's an awesome trade.
Yeah, for this, Mark, for the people out there that don't have the portfolio margin accounts, you can do this also with futures options. What would be a way of using this trade with futures options, like maybe going into a crop report or something like that? Or
crop report.
How would you do this on like a more major index?
You can use ES options. For those that have margin issues, the way you can do it is set it up as dueling credit spreads as well. You can set up a debit spread and then a credit spread against each other. And a lot of times that'll clean up a lot of your margin. Like, just buy some really cheap, way out of the money call, and that'll clean up a lot of the margin most of the time. So, but yeah,
very
crop
good,
reports, oil reports, you name it. So.
That's an interesting one, and probably and a good one that we can close out on. We can do a real quick thing on Las Vegas Sands just because it was a pretty sizable trade went up out there. Las Vegas Sands LVS, they closed around $53 today, up about $1. Their average daily volume. Oh yeah, I was also pull up. Let's see, average daily volume for Priceline is about 10,000. They did 60,000 contracts today. Not entirely unexpected given that they have earnings today. See, Las Vegas Sands usually does about 84,000 contracts. They did about 240,000 today. They hit a new 52-week high yesterday, 55.47. Now they're down a little bit off that. People are betting that high was a one-time thing. We got a 1x2 put spread, so another ratio spread coming up here. This trader bought 20,000 of the Jan 52 halves, and he sold 40,000 of the Jan 45 puts. He got a net debit of about $1.08. And so he's looking for, a downside down to around $45 for this stock, or down about 14%. Not that much, I guess, aside from the 52-week high, not that much in terms of news coming out for this one, Las Vegas Sands. They have an expo, I guess, some sort of, some conference coming up next week. But other than that, it looks like this guy is just betting that the 52-week high they're going to be coming off that quite a bit over the next few weeks.
Yeah, I would say that, and then like should it continue to go down, he's probably be fine owning the stock around the 41 level or whatever the cost basis would be. Should it continue to go down?
Yeah. Either you guys watch the gaming sector at all?
Yeah. I think it's the interesting thing is Las Vegas Sands is far bigger a Chinese play than it is an American play at this point. They're one of the guys that got a big, huge deal into Macau, and they're making a major play there. Macau, I don't know if you know this, but most of the time, one casino in Macau outdoes the Vegas Strip. So it is just unbelievable kind of the gambling that's going on over there. So it's interesting. It's actually a Chinese play.
It's funny you mentioned that because we'll be taping our next live episode of the Option Block at the Macau casinos next week. So be sure to tune in.
Oh, nice. Nice. I like that.
A little surprise trip for all you guys.
Love it.
All right, and with that, we're going to close out. This is an interesting episode of the Odd Block today. Some interesting names. We kind of ran the gamut from silver to gaming to online ticket buying and everything in between. So, yeah, we're going to close out the Odd Block today, and then we're going to roll right into the Strategy Block.
The Strategy Block.
And welcome to the Strategy Block. And this is the segment of the show where we kind of sit back and discuss some of the interesting strategies or trading techniques that are relevant to the current market conditions. Usually we have Uncle Mike Tusaw regale us with some of his know your option strategies. We're going to mix it up a little bit this week. We're going to have Mark, what was it, Greasy Neatball or Naked deep naked option. I forgot what all the
it's
various.
now called Uncle. Well, now that I'm doing the strategy block, it's Uncle Greasy Meatball to you.
Uncle Greasy Meatball. All right. We're going to hand the reins over to Uncle Greasy Meatball, as frightening of a prospect as that may be, and we'll see where he takes us for the strategy block. So, Uncle Greasy Meatball, where are we heading today?
Well, today we're going to talk about understanding how liquidity may change on you with splits, and then we're going to talk a little about VXX, which is one of the volatility products. As many of you know, we had Bill on a couple of weeks ago, Bill Luby, and he was talking about the fact that the VXX, because of this futures contango, is kind of on a downward path. Well, Barclays likes the fact that this stock, this ETN, it's not a stock, trades over and over and over again and does just a lot of volume. For instance, today, it did volume of over 22 million shares. Well, as this thing drops below $10, it's going to stop getting some of that volume. So what they do, they have written in their prospectus a 4-for-1 reverse split. So tomorrow, VXX is going to split 4-for-1. So that means if you're holding 100 shares, tomorrow you're going to be holding 25 shares. But those shares will be worth a little over $45. Now, what's going to happen with the options? Well, the first thing that's going to happen is they're going to adjust all of the options so that they're actually worth 25 shares. Then, those will trade all day tomorrow. Okay, those will be active. Then, starting on Wednesday, they're going to start rolling in the regular issues. Okay, they may hold off on November because it's so close to expiration, but probably not even that. And then relatively soon what's going to happen is that these reverse split options, these special options, will see their liquidity completely dry up. There will be no trading on them. The markets will widen up. Okay? So if you are holding one of these because you think VXX is going to go down, okay, as I was leading into today, it is important to understand how the liquidity is going to change on you and in this product. Over this week, you're going to see the liquidity in the options that you currently hold in VXX dry up to almost zero. So I would, in those shoes, look to close out that position, maybe probably tomorrow, okay? Maybe tomorrow being Tuesday the 9th. Maybe hold out till Wednesday. And then if I'm looking to get back into VXX, which I personally will be, I would then reopen when I'm getting these standard shares. The lesson, you don't want to be an owner of these specialty options, okay? Those are good for market makers, bad for the trader, okay? And that is something that you can take home and trade on.
Is that one to grow on, Mr. Sebastian?
That is. For sure.
Yeah, that kind of hits a good universal truth, particularly for the high-end retail guy, that, you don't want to play in some of these very shallow pool illiquid options if you don't have to, because the market makers will take you to the cleaners in a lot of these products. You want to stay liquid wherever we possibly can.
Yeah.
Forgot, did we mention what VXX is for the uninitiated of our
listeners? It is the iPath S&P 500 VIX short-term ETN. It attempts to recreate constantly being 30 days out with the VIX futures. And it does a really poor job of it. So, what? It does. I mean, take a look at the VIX futures and take a look at the VXX, and you tell me how good of a job it's done.
That's why you hold it then, for performance?
Oh, yeah. No, I'm holding put options. I was holding put options in it today, and I actually unwound the balance of every put option that I held today and closed up any short call spread I had on. So, the thing is that these splits can really throw off your portfolio. And actually, there are ways that you can be holding positions that when they go 3-for-1, you can actually lose money on the trade. For instance, I think there are 3-for-1 splits where you can actually lose a dime. So it can actually, the premium actually can get reduced, and the expiration price can go to from 50 to 49.10. It's a really weird thing, but when you get into these fractional splits, it is a messy, dicey situation. And if you know your stock is going to split, I would strongly suggest unwinding the options ahead of it. Mike, I'm sure you kind of would be on board with that general approach as well, correct?
When in doubt, get out. I mean, it's one to where you don't want any surprises. You don't want to mess around where there's no liquidity. I'm definitely a fan of that.
You know, that might be worth, I guess, down the road, maybe revisiting and even beyond just the VXX for just, because that's a question we receive quite a bit and we deal with quite a bit at the Options Insider. I'm sure you probably do as well with your customers over, or your clients over at Know Your Options as well, which is, you know, what happens when my stock splits, what happens to my options, that sort of thing. It's a very common refrain out there, so it might be worth revisiting down the road a little bit and maybe doing even longer about it. But that's a good, I think, introductory primer to some of the dangers of holding on to some of these weird split stocks that are coming on up there.
It does. Now, one thing that I'd like to mention that I tell all my clients to do, or what I do, I tell them all to call me if something like that happens, but if you're dealing with a stock that has a split, a special dividend, 888 Options. Those guys do a great job over there at the Options Clearing Corporation, and I think it's something. It's unbelievable. It's like these guys, I'm very humbled every time I talk to them because I thought I understand the concept of a split, and I'm like, wow, so that's what happened with that stock, and that's what it's amazing how good of a job that they do, and I'm not able to say enough good things about 888 Options.
Yeah, you know, that's something we probably don't plug enough on the show is some of the free stuff you can get over at the OIC guys. For those who don't know, that's the Options Industry Council, and they have a free hotline. In fact, for a long time, that was their URL. It was 888options.com because they wanted to push that URL. But yeah, they have former market makers hanging around there on the phone lines to talk to you and answer some of your very specific questions, all completely free of charge. So if you have a question on some of these esoteric concepts, give them a call. Most people don't even know it exists, so you probably can get through. They actually know what they're talking about as opposed to a lot of these other maybe answer lines you'll see touted out there. And you know, because it's OIC, and you know they have no agenda whatsoever except from educating you about options. So that's a good recommendation, Mike. We probably should mention that more during the show. All right, and with that, and good job there, Uncle Mark. We'll have to go back to you again down the road for some other interesting concepts. But yeah, good job on that strategy block. And with that, I think we'll close out that section and move on into our final segment, Around the Block.
Around the Block.
And welcome to Around the Block. This is the section of the show where we discuss what's on the calendar for the next few sessions. And a lot of the big stuff is primarily behind us. Obviously, the election was last week. QE2 already happened last week as well. Those were the two big events. We're still kind of sorting out some of the fallout from the latter there. In terms of earnings, a lot of the big names have already come out. Interesting ones on the horizon, at least for me. I know IBM is tomorrow after the close. And we've discussed a bit about Microsoft in the past and, you know, Apple and Google and Sony, all these other ones. And you don't hear that much about IBM anymore and kind of, you know, where they're positioned. And, you know, they used to be the big tech bellwether. They used to be the big name in technology, and where IBM went, the U.S. and the global tech economy went with them. And these days, it's a different story. You know, they don't make laptops anymore. They sold that off to Lenovo. They kind of stick in that middle enterprise market. And granted, that's a good business to be in, but they're no longer the bellwether of maybe the consumer technology side. But an interesting one to watch nonetheless. Either you guys play around in IBM at all?
What's the ticker symbol for IBM again?
I think it's QVZ. Try that one.
There we go.
That's funny.
Yeah, we took it. You know, it's IBM. It seems like as a portfolio manager in years past, I remember like if you read Peter Lynch's book, he always said that it was like an unwritten rule that you just had to have IBM in the portfolio, so to speak, or you weren't really managing a portfolio. And I agree with you. Now it's not really like it once was. And that it's not the popular Yeah, IBM, it's not the tech bellwether that it once was. I'm definitely in agreement with you on that. And we don't have any clients in IBM specifically right now.
I have a bit of a personal attachment to IBM. That was the first pit I really kind of started off clerking with down at the SIBO. And back in the day, in the late 90s on the SIBO, that was, before all the multiple listings started happening, that was the big pit aside from like SPX out there. It was the big equity. It was like the big name, and SIBO did all the volume in IBM. So it was kind of the place to be for quite a while. We had IBM and Starbucks out there. I forgot what else was out there, but those are the two big names in that pit. So I always have a bit of a personal attachment to that one. The one we have on the radar, this one kind of came up and caught my eye because we've talked about it on the show in the past. It is Green Mountain Coffee Roasters. And remember this one, I probably did this one in the odd block about a month ago or so, I think. And they have earnings on Thursday after the close. And I know we talked about them a little bit about a month ago or so. They had some unusual activity going on out there. And I haven't been paying too much attention to them since. But there might be a fun one to watch for those who've been listening to the show coming up on Thursday.
It's a slow one, and I'm not seeing a ton of stuff out there that I'm really super excited for. Save a few small names here and there, so certainly nothing special. So
it seems like everyone's still kind of digesting how this QE2 is going to be rolled out a bit, and bickering back and forth about whether this allotment and the way they're doing it and the schedule is optimal and all these other things. So I think we'll have a little bit of flux while people sort all that out for the next few weeks. But in terms of big earnings and big announcements, not too much going on for the rest of the week. Would you agree there, Mr. Tuso?
Initial claims, you can take a look at that, but unless something big happens, I definitely in agreement on that.
What about in the ags and the commodities? Do we have any big crop reports or anything interesting coming out in that sector the next few days?
Not to my knowledge, no. We typically aren't following wheat or the ags too much. Gold, it's just gold and silver, the ones with which we're following primarily. They just continue to go up. It's just ridiculous, and so they continue to screw up all of my hedges on them. But once again, good problems to have.
Yeah, rolling those puts to the upside, that's a rough one to deal with. Damn those puts expiring worthless. Damn them.
Yeah.
I'm sure your clients are very upset at that one.
Well, it's just I have the constant fear of the snapback. The client has the constant reminder of how come I'm not making more money. So I'd much rather have this problem than the other problems that you could have. So
are you getting those calls? Are you getting those why are you wasting my money on hedges kind of calls?
Oh, all the time. And it's only natural. It's one to where this is a true story. I had a client that had a significant amount of capital at a self-directed account elsewhere, and she had an account with us, and it was a pretty tightly hedged account. And with that, she had on the day of the flash crash. And so I got a phone call days later just saying, you know what, I lost probably about 25% in my account that wasn't hedged, and we're break even over here. Now, we weren't break even because I was some type of genius trader when the market was going down. It's just that we had such a gamma explosion to where I was actually a little bit overhedged and had to start pulling some things off. But it's ironic that at that point in time, when markets pull back and do what they did in the summer, it's great for business for us because our message is being protective to your portfolio. Whereas right now, when I tell people, well, we're behind the market, but we're right on pace to where we want to be overall because of the fact that puts aren't free, it's an interesting war to fight. But once again, I'd much rather be on the side of it.
Oh, couldn't agree more. So
such is the fate of the perpetual hedger. When things are looking good, people are upset you're wasting their money, and when things are bad, they're upset you didn't hedge them more. So
right.
you can't win on that one.
It's a lose-lose.
All right, I think, and with that, we will wrap up this episode of the Option Block. I want to thank you guys for coming on as usual, and if you want to know more about what Mike Tucson and the gang are doing over at Know Your Options, and surf on over to knowyouroptionsinc.com.
Oh, yeah. Hey, Mark. On Wednesday, starting Wednesday, I'm doing a special seminar, a 4-part seminar on volatility. You can read about it at optionpick.com/events. It's a really inexpensive way to kind of really learn about how volatility reacts and how it functions within options. And if you have any interest in kind of really digging, opening up the hood and really learning about how options function, you should definitely check it out. I think it's going to be a really, really neat seminar. It's going to be about 8 hours of education that's going to end up being about $30-$40 an hour. So it's really, it's going to be a really nice seminar. So I'd invite everybody to check that out. optionpit.com/events.
Well,
So.
you heard it here first. Go check that out over at optionspit.com/events. And we'll have to post a link to it in the show notes as well. Yeah, and I encourage all of our listeners, you want to know more about what's going on with volatility, and you just want to hang out and listen to Mr. Sebastian's tinny tones, and by all means, sign up for the is it a webinar you're doing then, or?
Yeah, it's going to be a 4-part webinar. And we're going to kind of talk about how volatility affects options, then kind of your trade selection, your managing the trade, and your decision making and closing or staying with a trade. So
sounds good. And even though they couldn't make it today, they're quite busy on the customer desk there. We'll give the OX boys a plug. Of course, you can visit them at optionsexpress.com for more information on anything they've talked about, and we hope to soon have an option block page on the OX website, so you guys can go visit and listen to and stream the show from there. And of course, with all the unusual activity and other info we talk about on the show, you can find it all at theoptionsinsider.com. And I want to thank you all for listening, and we'll see you next time on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved.